Hello everyone and welcome to TTT Markets. I am Fotis Papafeofanos, and in this video we are going to discuss why high probability trades still lose money. This is one of the most frustrating things in trading. You take a high probability trade, everything looks right, the structure is clean, the level is respected, the setup is exactly what you've been waiting for, and still the trade loses. So naturally you start asking, was this really a good setup? Is my strategy even working? But here's the truth. Even high probability trades lose money all the time. And in this video I will show you exactly why using real chart examples. But before we go to the charts, we need to clarify something. A high probability trade does not mean it will work. It doesn't mean that. It means it has a better chance than random. That's it. Maybe 60%, maybe 65, 70, which also means a large number of these trades will still lose. So let's go to the chart. So we have the Euro USD 4-hour chart here. You see we have the moving averages, the MACD, the RSI, our trend lines, and so on. So look at this structure over here. We have a clean trend to the upside, we have higher highs, strong movement, we get a pullback into this level, we have the moving averages, we have the trend line, we buy, this is a high probability trade, we buy. It works, it goes up a little bit. Now it depends on your trading plan whether you take profits here or you are expecting a move higher, but that's irrelevant. The point is that right here at support we have a high probability trade. This is a textbook setup. Why? As I said, we have a clean level, we have a confluence of moving averages, we have a trend line support. So everything makes sense. But now, watch what happens in another example. For example, how about if I zoom out and take a look at this? So I have zoomed out so you can see better. So what have we got here? The same thing. We have a strong breakout because of news releases to the upside. Price comes down. Actually, we have two areas. Here, again, the same thing. Moving average support, it bounces back higher, it touches this level again, and this time we also have the trend line support. Can you see this? Right here we have the trend line support. And is it breaking up higher? No, it is breaking lower. So the price is breaking the structure but stops you out. So this is also a high probability trade, but it doesn't work. So this is important. Nothing about this setup was wrong. The strategy was not wrong. You didn't do any mistakes, but something did change. The environment shifted. So look closely. Momentum slowed before entry. How can we tell this? Well, look at the MACD. It is red, yes, it is improving, but it is still very weak, just hovering around zero. So this means momentum is slowing down before entry. The candles are becoming smaller, which means that the true range is smaller. So we have smaller candles. And buyers were less aggressive. They were not interested to do business here. So this is it. So this is subtle but critical. The setup was valid, but the conditions were weakening. So this is the key insight from this. High probability is not the same as guaranteed outcome. They are not the same things. High probability will work only when conditions align. And conditions are always changing. Let me give you another example in the dollar yen. So what have we got here? Here we have an area that momentum is stable, we have a range-bound market, We do not have a trend, we have minimal pullbacks. So maybe this is easier to trade. You might say, I am selling the highs, buy the lows, sell the highs, buy the lows. So this is working until when? Until it stops working. And I can go back, let me zoom out, and I can find another example. Again here, the same thing. Sell the highs, buy the lows. Sell the highs, buy the lows. So this is different than the Euro-USD example. In the Euro-USD example, we were looking at momentum trades, continuation trades. Here we have a range-bound market, a market that moves sideways. It works here, sell highs, buy lows. It was working here for a while. Sell the highs, buy the lows. Until when? Over here, we had a breakout entry. If you are a breakout trader, you say, let me buy. It is breaking out of range. It gets out, consolidates for a little while, and then it moves back inside. High probability trade, let me buy at the trend line. No, it doesn't work. Let me buy at the trend line here. We also have the moving average support. This is another high probability trade. It doesn't work. It moves lower until it finds support at the 200. What is my point? That you can see everything works until it doesn't. When does this happen? When the regime, when the environment changes. So it is the same kind of trade like the Euro-USD example. If you look at the momentum trade, we have trend line support, we have a moving average, we have the RSI being oversold, and still the stop loss would probably get hit and you would lose in this trade. Why? It is the conditions behind the setup. So most traders, this is the real problem they will face. They evaluate trades like this and they say, oh, did it win or lose? This is the wrong question. You should be asking, was the environment supportive? Did I use the right strategy at the right environment? If the environment changed, then of course I lost. Maybe then it is possible that I might not have the outcome that I need. Was the environment supportive? That's the question you should be asking. Because a good trade in bad conditions will sometimes or often lose. So let's go back to the Euro-USD. So here is the Euro-USD. So you might have, you are trading, you're taking one trade, you have a loss. Second trade, a loss. Third trade, you have a win. The same setup each time. So trade number one, you have a win. This is the same setup. Second trade, you lose. Third trade, you lose. You have another trade, same setup, you win. Another trade, you win. You see my point, same setup, different outcomes. What happens after you stop, after two losses? Well, you miss the winning trade. This is where most traders fail, because they judge too early. High probability trades only work over a series of trades, not individually. So let's go deeper into this. Let's look at this trade that we were discussing before. Let me zoom out. So we have this setup here, same setup, but look at the entries. Early entry versus late entry. It makes a difference, a big difference, if you enter here or if you enter over there. If you wait for confirmation and if you wait for that strong candle to get in, can you see the difference? It is a big difference, isn't it? Because the first entry, if you enter right here, according to your strategy, you have better risk, you have better positioning, better reward risk. But the late entry, you have a worse price, you have more exposure, you have a worse reward risk. It's the same idea, but a different outcome. So timing matters. So there is another factor to consider, the liquidity crab. So here is a classic scenario. Price comes into a level, it breaks slightly, then reverses. This is a liquidity move. For example, if we go here at the dollar yen, we have a breakout, it consolidates, it comes to a level, it breaks, and then what happens? It reverses sharply. This is a liquidity move. Many good trades get stopped here, not because they are wrong, but because the market needs liquidity first. So even correct ideas can be stopped out before they work. This is where it gets dangerous. After a few losing good trades, you stop trusting your system, you hesitate, you skip valid setups. And then you go ahead and you find out that the next trade would have worked out perfectly. So this is creating inconsistency, not because of strategy, it's because of your reaction. But what professional traders do, they accept the loss and they focus on execution and they think in probabilities and they trust the process. They need the system to work out over time. So across both charts, you see the same thing, whether it is the dollar yen or it is the euro USD, you see good setups winning, you see good setups losing. That's normal. That's trading. The edge is not in perfection, it is in consistency. Because high probability trades don't guarantee profit. They give you an edge over time. But this will happen only if you execute consistently, you understand the current conditions, and you don't judge trades individually. Because in trading, the outcome of one trade means very little. The outcome of many trades means everything. Remember this, in trading, a good trade can lose and a bad trade can win. What matters is not the result of one trade, but the consistency of your process over time. Thank you for watching. See you in the next video.